When you are ready to begin the presentation, press the Start Broadcast button on the GoToWebinar control panel to allow all attendees to hear you. This system will notify you once you begin your broadcast. The broadcast is now starting. All attendees are in listen-only mode.
So that wraps up the session. Are there any questions? Greetings, everybody. How's everybody doing today? Special day here for Disruptive Traders TV. It be a Tuesday here in the States. I was scared. I don't know how I'm doing. I haven't any sleep in like a week, so I'm in that state of what? Hello? What? Hey, Ryan. I did pull a good April Fool's joke yesterday on a friend. I know. I'm going to talk to Haley. Haley, are you here? Oh, let me see. Congratulations, Andy. I don't think she's here. Yeah, I know. There we go. Do it that way. No. Yeah. So let me see here. Well. So anybody that has weak ears, it's not really foul. It's just there are some S words that get dropped. But I just had to play this response. I've played it 20 times and laughed every time. All right, hold on. Let me see here. And then we'll get started. But oh, it was a bad trick. It was a bad stunt last night, but I got her. Hold on.
I hate you! You're such a shit! I hate you!
Couldn't have been better. No, Mackenzie. All right. It was a doozy. Yeah, so Bitcoin, kind of interesting here. So 5-minute chart, right? Just having a little fun. But you can see on this particular pattern, using the XA, creating the C with the big wick tag, and of course we come down, bounce 80% to the median right there, median hit right there, and we just passed this. I was curious if it was going to hold it, but it didn't. Very volatile candle, obviously, big candle. maybe some other stuff at play here that we'll see what happens, but I just thought it was kind of fun. Been making its move today, huh? So, for those that don't know, this is, there we go, Disruptive Traders TV, and I do believe, yay, we have our title slide. So Mondays, Wednesdays at 5 p.m. Eastern, get your friends here. We cover scans, forks, fibos, and bears on sharks. I mean, waveology. So, all right. So, I want to bring up a chart here that, interestingly enough, Clay was looking at the 30-minute level of the day, and I was looking at the 10-minute level. I had my reasons for the 10-minute level, but a couple of things here to point out. One, this is an XA fork, and we are going to put it on the C at the top, close to it. So XA with the C touch, and you could see at 3 and 4 there were 3 good more touches to help align the fork to the C. So pretty nice touch there. Price then leaves the C and en route to D is stopped with a scouter wick at the median. Pretty cool. Love you XA forks. Love you harmonic scan for allowing us to create the XA forks. XA with the C touch, XA with the D touch. Can't do an XA with the D touch because that'd be pointing up, and this is a swing low to swing high, so it's got to be a down channel. So yes, I don't know if you can see it, but 5 represents the median line. 6 represents a shadow band that wick just happens to hit. And that is the triple trifecta hat trick, 7 being the DC down 45. Are you kidding me? But this stuff's too random. Can't trade this. Can't trade this stuff. It's too random. Triple energy point. DC 45, boom, Zoe says. Yes. So, pretty cool stuff. Harmonics at play, Fibonacci at play. Let me count the Fibonacci's at play here. Yeah, it was the shadow band 34. That's why it's a triple. Median set, shadow band, DC 45. Again, remember, DC 45 comes from an institutional trader. I've never, in my 16 years of trading, ever had anybody else share that with me. Tell me about it. I think our traders are the only ones in retail trading that maybe know about it. I wasn't supposed to tell anybody, but it's too good not to share because it does do its thing. Just don't tell anybody, right, Beta? Just don't tell anybody. Shh. So the shadow bands here are local shadow bands, which means they are placed on the 10-minute chart. So they are 10-minute shadow bands. The yellow is the 10-minute 62, natural, native, local, whatever you want to call it. DC means daily close. So it's an absolute pip count from the daily close on every chart. 45 pips down, 45 pips up. Generally tags it once in a 24-hour period. Not both, but one or the other. Doesn't always hold it. Sometimes it bounces and breathes. Sometimes hot knife through butter. But there are times where it bounces it. And in this particular case, boom. Interesting how that math works out. It's exactly 45 pips. So we called it the DC 45 because it's 45 pips from the daily close up and down. Now we've already moved into a new day. This is a static shot, but this was as of, earlier today, where that was the DC 45. Josh and Clay are telling me it was a trend line bounce on the 30-minute chart. So what I want to do now is take a look at this, keep visibility on, and drop down to take a trade. So you could see the slight diagonal of the median of the pitchfork right here, approaching the DC 45, which is the dotted line. They meet right at the circle. And then, of course, the pitchfork continues up past the DC 45 as we cross this point. But here's what I want you to look at. Tab 29. We have the 30-minute waves already down there. We have the 5-minute wave, the 15-minute wave, and the 1-minute wave converging. The 1-minute wave bends up. Boom. We have all green. We have a trade. Now, once that trade takes off, I'm back to my 10-minute chart. I'm not going to get RAS shaken up by pullbacks and wicks on the 1-minute chart. Now, what about the naysayers that would go, wait a second, it's so cool of you to find this one and call that a trade? Wasn't in a trade here. Everything was down. The 1-minute wave starts coming up. Looks like we have green. And the answer to that would be yeah. The trouble is, what's your reason for taking that trade? As an experienced trader, when you're, well, you can see scale, 5 pips. As an experienced trader, when you're 5 or 6 pips from a major energy point bounce, you could take it saying, well, maybe it's just close, maybe it doesn't have enough power to pull it down, enough gravity, enough suction, enough whatever you want to call it. But let's just say you were a pure indicator trader and you said, look, we were down here and it took off. And I got green. You say this one is ruled out because there was no green. So we don't get the green until we get this little tiny one right here as it starts to head back up. And that's this move right here. Then what happens? 1-minute wave stops mid-channel, turns around, starts coming down. Means you entered over here and you're exiting over here. No loss, no 20 pip loss, no 500 pip loss, no 50, 100 pip loss. Once I see 3 or 4 blue candles, it's not even a pip count. It's just my own subjective. Once I see that's the impulsive move you're looking for. You're looking for a hard bottom and an impulsive move. And I have 4, 5, 6 blue candles in a row on my 1-minute chart. Even by here, I'm close to, that's 7, 10 pips up, 10 pips up, maybe to there. I just don't need to be in it because look, what am I trading here? This is a 30-minute bottom. I'm not worried about 1-minute extremes. I'm not even worried about 5-minute pullbacks. Of which I have none, so I'm cool. So it takes off. There's no absolute way to teach this, to trade this, and therefore there's no absolute way to teach it. And I have to remind everybody, U.S. regs are kind of tight, and educators, if we're not careful, we could be picked on. And what that means is, if we're not licensed to be a financial advisor, we really can't say, get in here. We can teach a strategy that says, get in here, exit here, take profit here. Which is why we have things like Hall, which is why we have things like legging down, which is why we have things like harmonic targets, which is why we have things like Fibonacci, which is why we have things like INS, which is why we have things, Camarilla lines, pivot points, where you could hide software, you could hide your stop loss behind various points. You get to make the decisions on it. I expose you to all the ways you can trade it. And we have tools here that say you can get in here if you want. You could wait. There's all sorts of stuff, right? But I can't. Sorry, Mackenzie, my head's slow today. Oh, trend bar flip. It depends on your skill set as a trader. Depends on your risk aversion. I encourage new traders in their demo accounts until they get a volume of trades to wait for 2 pips of pullback and a trend bar flip. And I tell them at the 1-minute level, at the 10 to 15 minute level, you really don't want to go more than 2 to 4 pips. That's just, standard. This trade here, if we actually measured it, but it's not a 15-minute trade. This is a 30-minute convergence. So I'm looking for a 30-minute trade. That's what I would be looking for. You could get 10 pips and get out or whatever you want to set. But from the looks of it, it's the second candle. So it went up, came back and closed. So then I have to wait for the next candle to go blue on me. That's right about here. Here's our 5 pip line. So it's right on the 5 pip line. But I'm getting in about 2/3 of the way through. So I'm only about 3 pips into the move, which is just fine, even for a 10-minute trade. Triple energy point. So experienced traders will see the triple energy point. They'll see the convergence, and they'll go 2 pips and I'm in there like swimwear, like Brian used to say, right? I don't need a trend bar flip. I'd look to make sure I got it as price was taking off, so I'm not anticipating a quick reversal. But now that's not given sanction to newer traders to do a non-trend bar flip in their first 50 demo trades. It's not, creep, crawl, walk, run. And, you can do different strategies in terms of money management. Go back to our 10-minute. you can establish the quads as take profit points, or the ox as take profit points, legging down. There's 1, 2, 3, and 4. So 20% each, still leaves you 20%. If it hits the top of the fork, you could stay in, exit another 20%, let the last lot stay in with, you're on a 10-minute chart, so have my 10-minute haul on it. If it's gone that far, 10 minutes should be well into my direction, maybe move to the 30-minute haul. Just set the pitchfork then as my stop loss in case price comes back. Because I don't want to get much less than if I had taken everything out there. So if I'm going to go past a normal target with 10, 15, 20% of my lots, I want to make sure if it comes back, I'm not going to go negative on those. Well, I don't mean negative, but less than 100% that I could have had if I'd taken out. The dotted EMA. What's the dotted EMA? No way. If it was a 1 minute 62, it would be white. If it's a 1 minute 62, it'd be white. Yeah, I'm muting myself. Let's look at what we have on the chart. We've got in yellow with shadow bands around it, so that's obviously the 10 minute 62. We've got the aqua, which is almost always the 30 minute 62. Tell me more, Perry. Nope. You're close, Mackenzie, but nope. Yeah. It's the 10 minute 60. It's the 10 minute 13. Beryl got it right. Mackenzie got it right. It's the 10 minute 13. I just dotted it because we already had a yellow line on the chart. So normally the 13 EMAs, we would color yellow on a 30-minute chart or on any chart, but you get chart confusion when we start doing MTFA and we have existing colors on a standard color, situation. So it's the 10 minute 13. So Perry and Beryl and Mackenzie got it right. Good. So lots of options there. 10-13, yes. So this is, I didn't even measure everything else because the screen was getting cluttered. In terms of projections, retracements, extended retracements, etc., for smaller moves like the BC. And I'd already missed the scan support and resistance. So very cool. Very cool. And that's all you need. You know, guys, scans come at you left and right. Here's what I would suggest. Pick 4 to 6 pairs that you want to deal with. I'm not telling you what to do. I'm just giving you some ideas. Pick 4 to 6 pairs that you want to work with. And then have 2 charts that are just, this could be anything. For 10-minute forks, you don't need to have big 4-hour analysis for a 10-minute trade on a pitchfork based on a scan. You don't need to do big upward frame analysis. Why is that? Why don't we need to, what about the trend is your friend, Steve? Each time period has its own trend because we're looking for burst trades. It's not that relevant when trading off such a smaller time frame, but help me understand why. A lot of slush and higher time frames, correct. Yeah, Rowan's getting there right on. Upper levels have multiple lower level waves inside them. Fractals. Waves, yes. Well, for one, we've had this discussion a couple of times. When somebody says you go with the trend, let's look at this. Because, even when you go to an analyst page, as well, the general trend for the USD is what? I've argued this now my entire trading career. What the hell is the general trend? Is it the direction of the daily chart? And then how is it being measured? I've said before, a lot of analysts that I talked to years ago said the majority of them use the EMA 89 and 144 as a tunnel, meaning they use the high and the low to create a tunnel for the 89 and the high and the low for the 144. And both tunnels of the 89 had a crossover both tunnels of the 144, and then you had a trend change. Obviously, if it was above, you had an upward trend. If it was down, you had a downward trend. It's really interesting to see how you define a general trend. And this was on daily. When I first learned to trade, you know what was done? Well, first of all, when I first learned to trade, the way we were taught was you go to the daily candle. Now you'll see how random this is. You go to the daily candle, and if the daily candle was up, you can only do buys at shorter time periods. If the daily candle was down, you can only do sells. Which means, one, it depends on when you got on the charts. What if you got on the charts 90 minutes after the daily close? Is the first 90 minutes dictate which way I can trade right then? You know, what if I have a candle that went way up and comes down, you know, is on its way down now and way up there during today? I get on the charts, you know, right here. Well, it was up in the morning, but all afternoon it's been down. So what's the daily trend there? Here's the bigger thing in terms of trend. What time period are you talking? Let's look at a large impulsive move, Elliott wave style, on a daily chart. We'll look at the 2 to 3 move. Down here, and it's going to go up here, 2 to 3. We know 2 to 3 is a 1, 2, 3, 4, 5 move. 1, 2, 3, 4, 5. Okay. Well, we can go down to the 8-hour level, 4-hour level, and we understand depends on what time of day, but at the 4-hour level, I might have an ABC correction. This is the daily move. Anybody that looks at this would say, oh yeah, upward movement. I can make this at the 3 to 4 to make it a little bit more convincing of the up move, but it's the same point. Well, at the 4-hour level in ABC, what that means is that entire leg, meaning this stretch right here, that's a downward move. That's a downward trend. So our daily move is up, the correction is down, which means what? If the daily wave is ABC, or if the 4-hour wave is ABC, inside that 4-hour wave, I've actually got, what's the A component? Whoops, better get the right tool. What's the A component? It's a 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Which means at the 30-minute level, I very well may have a down component, the 1 wave. I may have an upward movement, which is the 2 wave. And in that particular case, the 2 wave would be within the direction of the general trend, but it's also the shortest move and the most dangerous move taking the correction. And inside the 30-minute move, you know, if we isolate this 4 to 5, we got a 1, 2, 3, 4, 5, you know, at the 10-minute level, at the 5-minute level. So the whole concept of general trend, see, when I get down to that 5-minute level, whatever the general trend is doing doesn't matter. I got 3 or 4 layers above me that could be in the same direction, opposite directions. This would be an impulsive move heading down. Impulsive moves are what we want. Doesn't matter, it's in the opposite direction of the daily trend. The daily trend can't maintain its upward mechanism unless it has periods of downward thrust, i.e. corrections. And inside those corrections, we have impulsive moves at lower level. Instead of saying the trend is your friend, we should say the impulsive move, whatever time frame you're on, is your friend. There you go, Steve Greger Forex quote. The trend is your friend. Ah, BS, man, you don't know what you're talking about. The impulsive side of a move of whatever time period I'm on is my friend. Now, if I'm going to trade, you know, 8-hour moves, 8-hour swings, you're probably safer off with big stop losses and big take profits. You're you're a little bit safer going with the trend of the daily trend, assuming you know what it is, assuming you're accurate in knowing how to define it. But if somebody's teaching you, you're trading 10-minute charts or 15-minute charts, and somebody's telling, oh, you can't take a sell because the daily trend is up. Oh my gosh, you need to find another mentor. Because at that level, you have impulsive moves down. And as I just illustrated at the bottom there, some of the with the trend moves are corrections, and those really aren't where you want to be. You want to catch the impulsive move. It's going to go farther. Yeah, it's easy to get confused going from one time frame to another. Yeah, just like here. If we just looked at the section of chart we're looking at, somebody would have to call this an upward trend. Look at the impulsive nature of the move running to the median. So don't get the trend all confused. I'm not saying it's not a good idea to at least understand if you can see where the trend is, but if I'm going to trade daily waves, I want to be interested in what the daily trend is doing. I remember well into my trading career, like 5, 6 years, almost 7 years of my trading career, I went to an FXCM training. They had a big old conference. Last one they had, I believe, in the States. And they were teaching brand new traders. I mean, literally at the conference to learn how to trade. So we had a guy come out. He was a big analyst for FXCM. And they were going to teach brand new traders how to trade. And they were going to use daily trades. This had to be like some ex-stock guy. And now he's an analyst at FXCM for the Forex. Going to teach traders daily trades. I remember we watched. Brian went with me. We were sitting next to Rob Booker. We sat in Rob's session. Rob sat with us for this session. And they were using 400 pip stop losses. And you had these big moves. This is a daily chart. And we're talking that move, the length of that move might have been 6 months. And I remember a somewhat savvy, newer trader asking the speaker at the Q&A afterwards, can I take a sell? And the answer was no. You've got to trade with the trend. And the three of us looked at the chart that he actually had up there and saw that from here to here was about 3 months. So no trade on this pair for 3 months because it's against the trend. Yeah, you're going to wait a long time to buy those groceries. That's exactly right. And yet, inside this daily move, there were moments of opportunity of impulsiveness. Impulse. You wouldn't want to trade the up move because it's a correction. So if I'm down at the 1 hour level, at the 4 hour level, even the 8 hour level. So just that's what brand new traders are being taught. Yeah, I guess you switch to another pair, except back then, a lot of your pairs were just so highly correlated. The Euro USD, the Aussie USD, the Kiwi were all positive correlated. The Swissy, the Yen were all negatively correlated. And it's like, I guess I just go on a mountain adventure for 3 months until this thing figures itself out. No, back then everybody was taught to use 5%, so they weren't doing 2%. Which also made what an issue here with 400 pip stop losses and 5% into a trade. They're asking beginner traders to have some hellacious capitalization because they're not going to make any profit if they don't. We had 400 to 1 back then in the States. So, some people just get RAS tunnel vision on the trend thing. And I'm not saying it doesn't have it moments of significance, but if somebody says you're going against the trend, it's like, well, what are you talking about? What time period trend are you referring to? How are you measuring it? And are you aware of how Elliott wave works? Yeah, and these were big moves. I mean, as we were looking at it 6 months back then, these are easily 500, 700 pip legs or longer. Anyway, so be careful with trend stuff. So we can't, let's reduce it down to what it is. You got scans, forks, fibos, waveology. I always kind of position this, well, this is for intermediate to advanced traders. The reality is you could probably learn what a scan is in a day. And now you're fed these automatic scans. You can go through my pitchfork course, and while you'd best to be understanding what it's all saying in terms of the end result where we're going to do Charlie Delta pitchforks, you don't have that much to learn. You need to know Charlie Delta X-ray. You need to know X-ray alpha, C-touch, D-touch, and you have to know which way to point a fork. To where that XA, I'm either going to have one option, two options, or no options. Just depends on what the CD is and the angles and blah, 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 blah. About 5 years, well, no, it was a little later. So about maybe 10 years, 12 years, Michael. Retail Forex in the States started with the Commodities and Trading Act of 1998. That's when you can start doing spot trading in the U.S. Prior to that, if you wanted to trade, I knew some traders that I was working with, back in the 2004 era, 2005 era. Knew a guy out of Atlanta, pretty old guy at that point. Don't know if he's still alive, but he was featured in Business Week several times as a big Wall Street trader. He said if he wanted to trade a $100,000 contract, with where you have 1,000 to 1, 500 to 1 leverage, you could buy into very cheaply. But if you wanted to trade a $100,000 contract back then, it was 1-to-1. You flew to London with a briefcase of $100,000. You couldn't even place that trade in the States. And back then, hauling money around wasn't an issue. We didn't have Homeland Security and police confiscating your money. Literally, secret agent style, London fog trench coat, $100,000 in an attaché. Nobody checked it. Just got on the plane, took it with you, got off the plane, took it with you. So that's how it was literally up until 97. And then the Commodities and Trading Act, 98 in the States, and retail trading took off. And I tell you, for the first 5 to 7 years, it was just ex-stock day traders. And again, I'll mention that one more time. You still see remnants of that. That's why RSI defaults to 14, because that used to be half of a lunar cycle. It was all day-based. Is it possible sometimes to put the median of X-ray alpha to get fork in the right direction? The fork's direction is determined by the swing. If you go from a swing low to a swing high, the definition of swing high is I am not anticipating price going any higher. Why would I call it a swing high? Well, that's a swing, got to put a SKH, it's a swing kind of high. So if we have an X-ray alpha, it's got to go in the direction of the swing, which means if we're at a swing high, the subsequent fork has to point down, which means we could put the top on C. We cannot put the bottom on D, because then the fork would be pointing up. So when we have one option in this configuration, we only have one option for the X-ray alpha. Well, here's my look, like Clay and I were looking at some stuff the other day. Clay will laugh at this. We were looking at stuff the other day. And, we were both coming up with, for different pairs, we were coming up with some, off forks. And I jokingly said to him, shh, don't show this to anybody. The difference is, I've got thousands and thousands and thousands of forks. I've got multiple RAS sets that have different sizes. And so no, I'll say this one more time. If you've got less than 500 forks under your belt, what I would suggest is when it comes to Charlie Delta, meaning forks on a scan, here's what I recommend. Charlie Delta, X-ray. That's the only Charlie Delta fork. X-ray alpha with a C touch or a D touch. If they're both legit, you draw them both and wait it out. If you got a bunch of data from the C come into the D, you have no D to try. You've got to go with XC. It's got to point in the right direction. Once the D has been established, then you can do an X-ray D. So we have to have it come down and go back, start going up. Now I can use the D, assuming I could point the fork in the right direction. So you really only have, at most, a possibility of 3 different forks. And sometimes these disqualify themselves because of the direction. And so if I rule one out because it's the wrong direction, or it's not complete yet, that means I only have 2 forks I can draw. I can't draw a CDX if the C isn't completed. So if you're talking about putting a fork on a scan that's not completed yet, you have one fork. How hard is that? Now, the way you get more forks is what? 15-minute. Go search your pairs on 15-minute. Go search your pairs, at 5 minutes. You can take a 5-minute scan, put it on a 10-minute chart, put it on a 15-minute chart if there's not the same 15-minute one there. For practice purposes, it's okay to go to an hour. Look, you want to understand the relationships. The fractals are going to be the same. I could color this up, time period, and if you didn't see the prices, this fork is going to look the same on a 1 minute as if it was a 1-minute chart or an 8-hour chart. You couldn't tell me the difference. If you didn't see prices and you didn't see the chart time frame, you couldn't recognize the difference. And the things are going to happen the same. Now, obviously, if we go to something like an 8-hour chart, the intraday navigation system is not as valid. We can use chart support and resistance. We can use Fibonacci. But in terms of drawing the fork, in terms of seeing relationships like bounces, you're going to see the same kind of thing. Now, the reason you don't want to do all these off forks is because now you're going to get to a chart, you're going to try and mechanically, well, let me try the this, and what about the BC this, and what about the XA, BC, and it's like, oh, come on. Seriously? Why are you trying to be? Remember the old saying. Some of you might not be old enough yet. Maybe your parents, if you're too young, maybe your parents already missed out. But I'll go back to the greatest generation. The era my parents lived, which would probably be your grandparents. Have you ever heard the saying, don't be a jack of all trades and a master of none, right? Oh, he's a jack of all trades, but a master of none. He can do a little of this, a little of that, a little of this, a little of that, but hasn't mastered anything. That's what happens when you try and do too many things in your trading progression while you're learning. And why do you think these people that bounce from one signal product to another signal product, automated signals? Oh, let me go try this. Oh, let me go try that. Oh, let me go try this. Well, besides the fact that the bulk of those signals are always going to be while they're at work or asleep. So I trade a little of this, little of that, and they never get to be expert in any of it. Malcolm Gladwell, 10,000 hours to be the expert. Expert's what you got to be to make money in the Forex. You can be an expert. If I think, and people who've been with me a long time, okay, let me strain my eyes here. We've got different people here. Well, of course, Zoe's been here the longest. But there are other people here that have been with me several years. Two, three, see a couple 4 or 5-year-olds, 5-year, tenured traders. $15 months. That's good. But think about it. Think about those guys at Zoe, and even Mackenzie. Forget all that you know. If I came in and said, here's a scan, and I showed you where to get it, how to go through, rotate through time periods, see the scans, isolate one, And I showed you how to use the pitchfork tool and how to do an XA with the C touch as long as it's pointing in the right direction. I could teach you how to point in the right direction pretty fast. You have one fork to draw. You could go draw Charlie Delta X-ray C touch all day long. And I could probably get you into that in one day. How many kids are you bouncing on your lap, right? Now, you don't have the body of knowledge that somebody that's gone through the pitchfork course and drawn a couple hundred forks, but you can actually do that. And then continue to round out your knowledge as you demo trade and set these up. Don't, you newer folks, don't make this harder. I wish we had all these tools way back when. I wish we had scans, automatic generated scans when I was first doing pitchforks. Oh my gosh, even look at 2.5, 3 years ago when I was at IML and brand new traders coming through pitchforks with me then. We were at it maybe, trying to remember, 6 months before I even said you're okay to demo trade. We were just drawing forks, trying to get people to pick the right swing. Pick the right swing. Because that's something that takes time. Well, what about this swing? What about that? We saw, Zoe, the other coaches, we saw some amazing forks. Head turning, shake my head kind of forks. And you can't laugh because that's how we used to draw them. So everybody goes the same way. And as you used to say, nobody comes out of mama's womb drawing forks. It's not a native gift. It's kind of like yogurt. It's an acquired taste. So scans make it so super simple. Everybody was trying to do quick fire and all this stuff on scans to catch the D. And finally, I'm just like, this is stupid. Who cares about catching the D and the hit or miss? And I don't care what kind of old paradigm qualification you were trying to give it. They were still hit or miss the way that D can slide. Let's wait for the D to settle. Now at IML, their scanner doesn't draw from the C. You have to wait till it almost gets to the D. So we didn't have the advantage then of the C paint. So you had to wait. But we could wait for the D to paint and start reversing. Continues to extend itself. Whoops, all the quick fire people got stopped out. Wait for it to set. It starts coming, reversing in. Whoops, another group of quick fire people get stopped out as it extended itself a little further. And now it starts to come back. Now you put your Charlie Delta on. Pretty simple. 1, 2, 3. C, D, X. Third grader could do it. And now you're going to get trades. Since the D is set, I now have a choice of 2 possibilities for X-ray alpha. The X-ray alpha C touch or the X-ray alpha D touch or both. Because sometimes that possibility is there. It just depends on the scan pattern that you're looking at. In this particular case, if I go to green, if this was a longer leg down, then the D would be down here, and that way I could have the X-ray alpha with the C touch or the X-ray alpha with the D touch, because both forks would be pointing down. Since here it's shorter, we can't have a fork pointing up for a swing that starts, it ends with a swing high. Everything needs to be below that. So, lordy, this is so simple. And then you have the benefit of pitchforks being so Fibonacci based, and you don't have to validate these. You're going to have multiple touches no matter what. most of the time. And now, instead of waiting for the D to form and start to take off before we can draw our fork, we can actually come in here with this new scanner and catch trades on the way down, which is pretty cool. Now we have harmonic wave convergence to tell us, yes, this is the end of a particular, what particular wave is ending, 30-minute, 15-minute, etc. Okay, Luker, take care, buddy. So, guys, repetition is going to be the key. If you don't believe me, go to the experts in the modern era of what it takes to reprogram your mind, to build new neural networks, to erase old neural networks so you can create new ones. Bruce Lipton, Joe Dispenza, Viswanathan, however you pronounce his last name. They're all going to say, to program, it takes repetition. Would I ever do a class, live class on trading the C leg down? We can. It's no different. The C is going to be, at some level. It just depends on what wave structure we're looking at. But this is going to be either a convergence or a retrace extreme. And we have tools as we go from 30 to 15 or 10, whichever you prefer to draw, 15 or 10, all the way down 5-1. It's just a convergence point, just a retrace extreme. And then you have things like pullback moves, and tools to help us with that. And again, we could get in here and look at all sorts of things that can help us, be they trend lines, be they Fibonacci values, etc. Yeah, this top move here at the 10-minute level, not to get too deep on you, but you can see where scale is. So this, where's my pencil? I'll use colors. This move at extreme, which says that's a 15-minute or 10-minute wave ending, is right here. And then I use red. Look at that wave. Lower, C touches the pitchfork. What does that mean? Yep, the D word, divergence. So not only do we have a bounce, but it's a divergent bounce, so it's a great entry. Lower level is going to give you the trade. So you're in there. We've got lower level tools, 5-minute, 1-minute. We've got tools now, MTFA 62s. Told you, 513, 62 crosses. when the moving averages open up faster, creating a wider gap between the next one and the next one, 5 opening up from the 13, 13 opening from the 62, you're good for a while. Yes, divergence, there's a couple kinds of divergence, but there's let me just for grins. Don't know. Hang with me 1 second. Get my eyes focused. Could probably gotta drive down through some directories here. Give me a second. If I can spell now. Going through about a couple 100,000 million. Oh, where'd it go? There it is. All right. So take a screenshot. You have reversal divergence and you have hidden continuation divergence. I don't like the hidden continuation divergence. Just reversal divergence or it's not divergent. No, it was formed. So the C touch was a divergent bounce. It's not a trend line. As soon as that move up exceeds the previous move, I know it's going to be divergent. Same thing here. I'm almost at the top and it's nowhere near the top of the next wave. It's lower. I know it's going to be divergent. Yeah, well, I don't mean it to be a trend line. I mean these to be measuring the previous wave swing high inside that channel. So as soon as the next move up exceeds the previous move, I know it's going to be divergent. Oh, no, it's not about the scan at that point. It's about the pitchfork. Oh, I understand your question now. Okay, now I understand what you're saying. Well, this is where knowing pitchforks. So the question is, we're talking about the fork being drawn as an XA because we can use the C, because the scan paints after the C, but we can't do that until, we're past the C and price is leaving the C. So now we have the C to actually touch because the scan is painted. But if you're a 10-minute trader, you would know to put a fork on that swing. And if you've been around me through my pitchfork course, you would know when I have 3-4 touches in a row, that's good enough to set it at and see what happens. So the experienced traders would see that. Yeah. But you don't know, the pitchfork is there in terms of, as I've been talking about, they're so easy to draw. So it's a correct statement to say I can't talk about this being so easy to draw and then go back and show stuff that happened before the C. So to illustrate my example of these are so easy to draw, boom, it's a valid point. If the pullback after the C would have been higher than the upper parallel a little bit, would you move your upper parallel to that point? Just depends on what I have in front of it. You know, I've got 1, 2, there's actually 2 here, and then a 5th one. Yeah, 5 hits. You know, I might get one that goes up a little higher. I don't know that I'm going to move everything because of 1. I got 5 there. This would make the 6th. There's 2 here. Yeah. There's also a thing that as you move through your years, you should self-discover, but it's not going to, it's not going to be your first couple of years. So, we have some issues. Well, not some issues. Right now, the harmonic scans from the Forex harmonic patterns link, i.e. harmonic pattern, they could pick off swings sometimes. So they're not true swings. They could be 3 candles over and a shorter wick, and you'll see it draw there. And traders will go, can I use that or not? The math of the sequence of the Fibonacci ratios works. And you say, but it's not a true swing. So many years ago, I haven't taught this in a long, long time. Lordy, lordy, lordy. Seriously? So what we noticed is there will be times, this is why you got to be a MacGyver and why you're not going to make it as a trader without being a MacGyver, and why those of you who are afraid to go to the laboratory to do your trading work are probably not going to make it, because you only learn from mistakes and you learn from MacGyvering. You learn from experimenting. So I better draw that a little bit more. What you'll see sometimes is this. Go back to red for down. And somebody will come along and they'll put their fib on here. Let's go yellow. And when they do, and they look at their 38.2, there it is. And you say, wow, wonder what turned that. No? And what you'll also see are things like, reverse compliance. Remember what reverse compliance is. Reverse compliance says, I'm going to measure something, in this particular case, I'm going to measure something in this swing before it gets to the bottom that has relevance to this 38.2. In other words, maybe right here we see this happen. Now watch what I'm going to do. Some of you are going to get it. The more I draw this, the more clues you're going to have. Oops. And we look at our Fibbo that we drew, and we start looking backwards for a reverse compliance, and here's our 61.8. And so what we realize is, for whatever reason, the universe, the translation to the woo-woo on the charts, got a miscommunication. And what it really wanted us to do was not use the top of the wick, but the body of the candle. And when we do that, we have a perfect 38.2 there, and our reverse compliance comes up perfectly with the 61.8 there. You don't just randomly do it, but there's enough times where you just don't have Fibonacci's happening, and it's literally because you use the wick and it really wants you to use the candle close. Yeah, it's probably been 3 or 4 years since I've taught that. Does everybody follow what I just said? You don't just do it. You do it to find when something's not right with your Fibbo, something's causing that, and for whatever reason. Now, this might be a number of stuff. This might mean if I look at 5 different vendors, 2 of them have this wick, 3 of them don't. That can happen. Because look, it's not always going to be, I embellish the size of it. But you're going to notice, oh, look, the 38.2 missed it by 2 pips. And oh, look, I see some other things here. The 61.8, if I go look in reverse compliance, it missed it by 2 pips too. And oh, look at that, the 50, it missed it by 2 pips. And I've got a 2 pip wick. If I dropped it, and it, of course, the way the ratios work, it doesn't have to be quite 2 pips. It might be 3 pip wick, and you pull it back 3, and all of a sudden the 2 pip moves, and the 1 pip difference elsewhere matches. So that's why reverse compliance is so important, because it gives you clues. It's kind of like a slider, but with Fibbos. Exactly. It's a good analogy, Mackenzie. Oh, what's your question? You asked it, so I'm probably ignoring you. But no, what? The beginner class? Is that what you're talking about? So anyway, that's why sometimes forks, or excuse me, patterns could be off candle. Sometimes they'll draw it and miraculously, whoops, there's your C or whatever, your D. And you go, wait a second, that's not the true swing. But yet, it makes all the other Fibos in front of it work. So the computer could crunch that out. Yes, that's in the works, Mackenzie. For some people. All right, so I'm going to end it there. Did I lose too many people on that Fibo thing? If I lost you, okay, we'll go over it again some point. Okay. So when you draw your Fibo, just draw it, and if you got good hits, forward and reverse compliance, you've probably got the right Fibo. But if you draw a Fibo and it's just missing things, drop it from the wick to the candle body and see what happens. It's cheating a little. But there are data feed errors, there are data feed differences, and there's a reason it aligns everywhere else when you drop it 2 pips to the candle body, or 3 pips, or whatever the move is. There's a reason. Oh, reverse compliance? Reverse compliance, well, we do that a lot in forks too. In other words, we can't measure 61.8 here because 61.8 is a retracement from the bottom up. 61.8 is a measure this way. So we can, even though the line goes clear across the page, you know, if you have lines extended, that line can't really be drawn until you've hit the bottom with your price. Oh, that's just a nothing line. So it's only good for stuff that way. So reverse compliance means behind the line that it took to draw this. I can't, until price gets down here to the bottom, I have nothing to set this for, therefore I don't have a 61.8. I have to know where the bottom is. Once the bottom ends and starts going up, the fact that this price came up and hit it perfectly, we just call reverse compliance. It's kind of reverse woo-woo is what it really should be called, but I just call it, I coined the term several years ago, a line is compliant when it has many hits. If I throw on my INS and I'm getting 3 out of 4 major Camarilla lines are being hit, we say it's very compliant with Camarillo that day. We could call it synced up. How's that? It's very, I can't say the word. Synchronized, but simpatico. It's very simpatico with Camarillo lines. It doesn't come close to bouncing off a pivot line. 2 days later, it's all over the pivots and Camarillos. You might as well just take them off the screen because nothing's touching it. This is why we have INS, because if you devote yourself to a particular support and resistance system, it's going to be right sometimes, it's going to be on sometimes, and some days it's off. And the days it's off, you're left without a guidance system. So why not have a whole bunch to scroll through and see that day which is generating the most hits? That's the one I want to put more emphasis on. Otherwise, I'm going to have 57,000 lines on my screen. No, shadow bands, 30-minute, 15-minute, 10-minute, 5-minute, 1-minute level. I can have 62s from everything, 13s and 5s and pitchforks at different levels. And oh my gosh, you've seen these charts, put the cloud on it and put 5 Bollinger Bands. And it's like you can't even see where price is. There's so many lines on the chart, right? So reverse compliance is really just reverse woo-woo. Remember, I've told you how this works. Try this sometimes. When you see a move that goes like that, and price is down here, dancing around, doing its thing, go ahead and grab a trend line and just put it right there, parallel, a horizontal trend line. Just for grins. Make it small dotted if you want. See, there's a reason this turned right there. It's going to be something in the past you probably can't see. But it very often is a predictor of the future. I told you the trick I used to do. First 3 years trading. First 3 years coaching. We'd have a big, because we used to meet in the mornings, and so things like non-farm payroll would go off. We wouldn't trade it, but we'd just watch. And price would be coming down. We'd see a little bit of pullback, and the price would go down. And I would tell my class exactly where price was going to end in this erratic news announcement move. And I'd be right a huge percentage of the time, almost to the pip. And they were like, how do you do that? I seemed like, Oz. I was just the man behind the curtain, but they thought I was Oz. You know what I was doing? I grabbed a Fibbo. And I would just start pulling it down until I'd see something like that. And I'd have it be 38.2. Pull it down. Oh, there it is at 38.2. So in other words, this is where price was going to end in order to give this 38.2 reverse compliance bounce. And what you'd see happen would price would come down, work its way back up, and there it would end before it started heading back down again. I didn't draw this line. They didn't see it. I'd just be pulling on the Fibonacci tool until I saw a major pullback like that. And I'd always use 38 and 50. So it's going to end here or it's going to end here in two lines. And I was right about 75% of the time. Yeah, look left. Had the Fibbo tool, pulling it down. They didn't see it. Look for that reverse compliance point. Eventually, I was so consistent, I had to show them because I felt like I was just deceiving them. I wasn't a Forex god. I understood enough about Fibonacci. Anyway, good enough for a makeup session. We'll be back tomorrow night. We'll look at some fresh stuff. If you guys look at your charts and you see something that was interesting, or you're curious about, or good reverse compliance example or something like that, let me see it. Tell us about it. We'll go look at it tomorrow night on the charts. All right, with that, we'll see you tomorrow. And so I'll remind you again, life can be short, sometimes even shorter than that. So for the people you care and love, let them know you care and love them. See you guys in Facebook land. I'll see you here tomorrow night. Bring your friends. Y'all have a great day.